The history of market analysis is a story of evolution, a continuous search for a logical framework to impose upon the seeming chaos of price movements. In this history, Charles Dow stands as the great philosopher, the man who first articulated the foundational principles of trend and market structure. But if Dow was the philosopher who drew the map, it was his intellectual successor, William Peter Hamilton, who became the master navigator. Hamilton was not the creator of the theory that bears Dow's name. He was its most brilliant interpreter, its most rigorous practitioner, and its most effective champion. For over 2 decades, as the editor of the Wall Street Journal, he took Dow's broad observations and forged them into a sharp, actionable tool for dissecting the market's health. This is not a simple retelling of the Dow Theory. This is a deep dive into one of its most practical and powerful applications, a specific set of principles that Hamilton refined to solve one of the most difficult and psychologically taxing problems any market participant ever faces. How to correctly interpret a market correction. In any major bull market, there are periods of sharp, frightening declines. These are the moments that test the conviction of even the most steadfast investor. Is this merely a healthy pullback, a secondary reaction, offering a buying opportunity before the next major advance? Or is it the first ominous sign that the primary bull trend is over and a new bear market has begun? Answering this question correctly is a key separator between long-term success and failure. This is the story of how William Peter Hamilton framed pullbacks, providing a logical, evidence-based system for navigating these moments of maximum uncertainty, centered around his famous 50% reaction rules. To fully appreciate the genius of Hamilton's framework, we must first understand the man and his role as the inheritor of Dow's intellectual legacy. William Peter Hamilton joined the Wall Street Journal in 1899, and after Charles Dow's death in 1902, he eventually became its 4th editor, a position he held with immense influence until his own death in 1929. He was a man of formidable intellect, a sharp writer, and a deeply analytical thinker. He saw himself not as a speculator, but as an economic journalist in the mold of his predecessor. He took it upon himself to continue Dow's work, studying the hundreds of editorials Dow had written about his theory of market movements. Hamilton's great contribution was to gather these disparate observations, to structure them, to test them against decades of market data, and to formally articulate them as a coherent methodology in his classic 1922 book, The Stock Market Barometer. He was, in essence, the architect who took Dow's foundational stones and built a complete intellectual edifice. At the heart of this edifice was the central problem of the trend. Dow had established that markets move in 3 trends: the primary tide, the secondary waves, and the minor ripples. For the long-term investor, the primary trend was the only one that truly mattered. The challenge, as Hamilton saw it, was that the secondary trend, the corrective wave against the primary tide, was the source of the most confusion and the most costly errors. In a primary bull market, a secondary reaction is a sharp decline that can last anywhere from 3 weeks to 3 months. It is a period of fear and doubt, often triggered by concerning news or an overbought market condition. Amateurs, seeing prices fall sharply, often panic and sell, believing the bull market is over, only to watch in dismay as the market reverses and soars to new highs without them. Conversely, in a primary bear market, a secondary reaction is a powerful rally that can convince the unwary that the worst is over, luring them back into the market just before the next devastating leg down. Hamilton recognized that developing a systematic way to identify and frame these secondary reactions was critical. He needed a set of principles to distinguish a mere wave from a true turning of the tide. His first and most famous principle for framing these pullbacks was his rule of thumb regarding their magnitude. Through his exhaustive study of the market averages going back decades, Hamilton observed a clear and repeating pattern. He noted that a typical secondary reaction would retrace between 1/3 and 2/3 of the preceding primary swing. For example, if the Dow Jones Industrial Average had a primary advance from 100 to 160, a 60-point move, a normal secondary correction would be expected to pull the price back by 20 to 40 points, to a level somewhere between 140 and 120. A pullback of this magnitude was considered healthy and normal, a necessary pause that refreshed the trend and shook out the weaker, more speculative participants. A decline of less than 1/3 was often too shallow to be considered a true secondary correction, suggesting that buying power was still immense. A decline of more than 2/3, however, was a major warning sign, suggesting that the selling pressure was abnormally strong and that the integrity of the primary bull trend was now in question. Within this 1/3 to 2/3 zone, Hamilton and subsequent Dow theorists paid special attention to the 50% retracement level. This level became the theoretical and psychological center of gravity for a correction. Its significance is rooted in the logic of market psychology. A 50% retracement represents the point of perfect equilibrium, the price level where the bullish forces that drove the first half of the advance are met with an equal amount of bearish force in the form of selling and profit-taking. It is the line in the sand. How the market behaves at this 50% level is a powerful diagnostic tool. If the market finds support at or around this level and the selling pressure begins to dry up, it is a strong indication that the correction is a healthy one and that the primary bull trend is likely to reassert itself. Buyers who were waiting for a significant discount have now been enticed to enter the market, absorbing the supply from sellers. However, if the market slices through the 50% level with ease and continues to fall, it suggests that the selling pressure is more than just profit-taking. It is a sign of a fundamental shift in sentiment, and it increases the probability that the primary trend is in the process of reversing. This framework of the 1/3 to 2/3 retracement, with a special focus on the 50% level, was revolutionary. It provided for the first time a rational quantitative guide for interpreting market corrections. It replaced pure guesswork and emotional reaction with a structured, probabilistic approach. It allowed the analyst to frame a pullback, to measure its depth against historical norms, and to identify key zones where a potential turning point could be expected. This brings us to a question for all modern market participants who face these same dilemmas. How do you personally approach pullbacks in a bull market? Do you see them as automatic buying opportunities? Do you wait for the trend to definitively resume, or do you view them as a warning sign to reduce your risk? Share your strategy in the comments. For Hamilton, however, measuring the depth of the correction was only the first step in a much more comprehensive diagnostic process. The price level was a point of interest, but it was not a signal in itself. The market had to be subjected to a further series of rigorous tests to confirm that the pullback was indeed just a temporary wave and not a turning of the great tide. These tests form the basis of a confirmation checklist, a topic we will explore in the second part of this analysis. Before we conclude this section, it is essential to revisit two other foundational tenets of the Dow theory that Hamilton championed, as they provide the necessary context for his entire approach. The first of these is the profound idea that the market discounts everything. This principle is the intellectual bedrock that makes a systematic study of price action possible. It posits that the current price of the market averages at any given moment reflects the sum total of all available knowledge, information, and even the future expectations of all market participants. This includes every conceivable factor: the hard, quantifiable data like corporate earnings, dividends, and balance sheets, the broad macroeconomic forces like inflation, interest rates, and employment levels, and even acts of God like droughts, floods, or earthquakes that could impact the economy. Most importantly, it also discounts the collective human element, the hopes of millions of investors for future growth and their collective fears of a future recession. The price is a single, constantly updated number that distills this unimaginably complex array of inputs. The implication of this tenet is immense. It suggests that trying to make investment decisions based on a single piece of news or a single fundamental data point is often a futile exercise, because that information is likely already in the price by the time an average person receives it. The price itself is the most complete, up-to-date, and relevant piece of information available. The job of the analyst, therefore, is not to act on the news, but to study the price action of the averages to interpret what the news means for the market's underlying trend. The second crucial tenet is that a trend is assumed to be in effect until it gives a definitive reversal signal. This is the market's version of the legal principle of innocent until proven guilty. It is a rule of patience and discipline, designed to prevent the analyst from prematurely calling a top in a bull market or a bottom in a bear market. Hamilton, like Dow before him, understood that a trend in motion is far more likely to continue than it is to reverse. The burden of proof is always on the reversal. A simple one-day sell-off, or even a week of declining prices, is not sufficient evidence to declare that a primary bull market has ended. It is far more likely to be a minor or secondary fluctuation within that larger trend. This principle acts as a powerful psychological anchor, protecting the analyst from overtrading and from being shaken out of a sound, long-term position by meaningless short-term noise. It forces the analyst to wait for clear, objective evidence of a trend change, rather than acting on emotion, opinion, or speculative forecasts. It is the ultimate rule of patience, and it is the necessary prerequisite for the confirmation checklist that Hamilton would use to validate the end of a correction and the resumption of the primary trend, which will be the focus of our next discussion. In the first part of our analysis, we established the foundational principles that guided the work of William Peter Hamilton. We explored his role not as the creator, but as the chief architect and interpreter of the Dow Theory, the man who took Charles Dow's philosophical observations and structured them into a coherent methodology. We delved into the central problem that fascinated him, the secondary reaction, or the corrective pullback within a primary trend. We deconstructed his famous rule of thumb for framing these corrections, the 1/3 to 2/3 retracement zone, with a particular focus on the 50% level as a critical psychological and technical battleground. But for Hamilton, identifying this zone was not a signal to act. It was merely the posing of a question to the market. A pullback to a logical level of support did not guarantee that the primary trend would resume. It was simply a test. This second part of our masterclass is dedicated to Hamilton's answer. We will now explore the rigorous, multifaceted diagnostic process he used to confirm whether a correction was a healthy pause or the beginning of a new primary trend. This is the confirmation checklist, a series of objective tests applied to the market's price and volume action that transformed the Dow theory from a passive barometer into a practical tool for navigation. We will deconstruct each of these tests in detail, explaining the logic and psychology behind them. Finally, we will examine the ultimate proof of his methodology's efficacy. A review of Hamilton's own incredibly accurate real-time market calls, published on the editorial page of the Wall Street Journal for all the world to see. The core of Hamilton's practical methodology was a checklist of confirmation, a series of tests that the market had to pass after a secondary reaction before the health of the primary bull trend could be reaffirmed. This was an evidence-based approach, designed to filter out emotion and force the analyst to make decisions based on the weight of the evidence, not on a single ambiguous signal. Test number 1, the volume signature. The first and most immediate test during a correction was the character of the trading volume. This principle, inherited directly from Dow, was a cornerstone of Hamilton's analysis. He understood that volume was a measure of intensity, of emotion, and of conviction. The behavior of volume during a pullback was, for him, a critical window into the market's psychological state. For a secondary reaction in a primary bull market to be considered healthy, he demanded that the selling occur on diminishing volume. As the price declined from its recent peak, he wanted to see the daily trading volume shrink. Low and contracting volume on a decline was a profoundly bullish sign. It suggested that the selling pressure was not aggressive, widespread, or panicked. It indicated that the majority of strong-willed investors were holding their positions and the selling was primarily coming from weaker short-term players taking profits. It was a sign of unenthusiastic selling, a lack of conviction from the bears. This drying up of supply meant that the downward pressure on prices was likely to exhaust itself quickly. Conversely, the most dangerous warning sign during a pullback was high and expanding volume. If a price decline was accompanied by a surge in trading activity, it suggested a fundamental shift in the market's character. High volume on a decline was a sign of urgency, of aggressive and determined selling. It indicated that institutional investors, the smart money, might be actively distributing their shares, and that fear was beginning to grip the market. This type of price action was not a healthy correction. It was a potential signal that the primary trend was in serious jeopardy. Therefore, the very first test was simple. Hamilton would watch the volume figures on the ticker tape as the market pulled back. If volume was drying up, the trend was likely safe. If volume was expanding, a major warning flag was raised. Test number 2. The confirmation of the averages. The second test involved a close examination of the behavior of both the industrial and the transportation averages during the correction. The principle of confirmation was not just for identifying the start of a new trend. It was a continuous diagnostic tool. During a healthy secondary reaction, Hamilton expected to see both averages behaving in a similar constructive manner. He wanted to see both averages find support at logical technical levels, such as the 50% retracement zone or a previous area of price consolidation. He also wanted to see the volume signatures align, with selling drying up in both sectors as they approached their lows. A divergence in the behavior of the averages during a correction was another serious warning sign. For example, if the industrial average experienced a shallow, low-volume pullback and held its support level firmly, but the transportation average experienced a deep, high-volume decline that sliced through its key support levels, this was a signal of internal weakness. It suggested that a specific critical sector of the economy, the one responsible for the physical movement of goods, was breaking down. This kind of divergence indicated that the selling was not just broad market profit-taking, but was concentrated in a fundamentally important area. Hamilton would view such a non-confirmation as a sign that the primary trend was unhealthy, even if the more popular industrial average appeared to be holding up well. The two generals of the market army had to retreat in an orderly and parallel fashion for the correction to be considered healthy. Test number 3, the character of the rebound. After the market had completed its pullback and found a bottom, Hamilton would then turn his intense analytical focus to the character of the subsequent rally. The rebound off the lows was a critical test of the market's underlying health. A genuine, healthy bull market should demonstrate resilience and a renewed appetite for risk. Therefore, he demanded that the initial rally off the lows of a correction occur on noticeably expanding volume. A surge in volume on the rebound was a powerful positive signal. It indicated that buyers had returned to the market with force and conviction. It showed that the period of profit-taking was over, and that strong, informed demand was now overwhelming the remaining supply of stock. The price action itself should also be strong and decisive, characterized by wide upward price spreads and a series of consecutive positive closes. The opposite of this, a weak and anemic rebound, was a major bearish signal. If the market rallied off its lows on very light, unenthusiastic volume, it suggested that the buying was not coming from confident institutional players, but was more likely the result of short covering by bearish speculators. A dead cat bounce, as it would later be called, is a rally that lacks the fuel of broad participation. It is a sign that there is no genuine demand to push prices significantly higher, and that the sellers are likely to re-emerge at the first sign of weakness. For Hamilton, a low-volume rebound after a correction was a failed test. It suggested that the preceding decline was not just a pause, but the first leg of a new primary downtrend. Test number 4, the ultimate confirmation, exceeding the previous highs. Even after a successful test of support and a strong volume rebound, Hamilton's rigorous process required one final definitive piece of evidence before the health of the primary bull market could be fully reconfirmed. Both the industrial and the transportation averages had to rally with enough strength to decisively break above their previous primary peaks. Until this happened, the market was, from a structural perspective, still in a pattern of either equal or lower highs. The bull market was not technically in a state of failure, but it was on probation. This is a crucial and often overlooked part of the Dow theory. The period after a deep correction is one of uncertainty. The rebound could be the start of a new leg up, or it could be a large secondary rally within a new nascent bear market. The only way to definitively prove that the primary bull trend was still in force was for both averages to demonstrate their underlying strength by pushing into new high ground. This was the ultimate confirmation. It proved that the buying power was not only strong enough to overcome the recent selling pressure, but that it was also strong enough to absorb all the residual supply that existed at the old market peak. It was only after both averages had registered new highs that a Dow theorist could declare with confidence that the secondary reaction was over and that the primary bull market had successfully resumed. This complete, multifaceted diagnostic process, analyzing the volume signature, the confirmation of the averages, the character of the rebound, and the test of the old highs, is a masterclass in structured, evidence-based thinking. It represents a way of interrogating the market, of forcing it to prove its health through a series of objective tests. Developing this level of analytical discipline is the goal of every serious market student. To continue forging these professional-grade habits of thought, and to gain a deeper understanding of the timeless principles of the market's greatest operators, we invite you to subscribe to this channel and click the notification bell. Let this be the place you come to build your intellectual framework. The true power of Hamilton's methodology was not just its theoretical elegance, but its proven effectiveness in the real world. As the editor of the Wall Street Journal, he was not a historian analyzing the past. He was a real-time analyst, publishing his interpretations for the entire financial community to read and judge. His record of calling major market turns, using the very principles we have just deconstructed, is nothing short of remarkable. A prime example was his identification of the start of the great bull market of the 1920s. The period following World War I was one of economic turmoil, culminating in a severe depression and a brutal bear market in 1920 to 1921. Public sentiment was at a low ebb, and many believed that the post-war economy would be one of prolonged stagnation. But as the market bottomed out in mid-1921 and began a tentative recovery, Hamilton was carefully applying the tenets of the Dow theory. He observed that both the industrial and the railroad averages had established a clear bottom. He then watched as the subsequent rally made a series of higher highs and higher lows. He saw that the volume patterns were confirming the advance, and most importantly, he saw that both averages were moving in harmony, each confirming the other's strength. Based on this weight of the evidence, he confidently declared in his editorials that the primary bear market was over and that a new primary bull market was underway. This was a contrarian call at the time, but it was one that would be spectacularly vindicated by the Roaring Twenties bull market, one of the most powerful in American history. Even more famously, Hamilton used his method to warn of that same bull market's demise. Throughout the late 1920s, he grew increasingly concerned about the wild speculation and euphoric sentiment that had gripped the nation. While he did not attempt to call the exact top, his editorials in 1928 and 1929 repeatedly pointed out the warning signs that the market was in the final distributive phase 3 of its advance. The ultimate confirmation for him came in the summer of 1929. The Dow Jones Industrial Average continued to surge to its final historic peak on September 3rd. However, the Dow Jones Railroad Average was unable to keep pace. It had peaked earlier and failed to confirm the industrial's final advance. This major non-confirmation was, for Hamilton, the definitive signal that the economic tide was turning. When the market finally broke in October 1929, Hamilton was ready. On October 25th, after the first wave of panic selling, he published a now famous editorial titled, "A Turn in the Tide." In it, He used the clear objective signals of the Dow Theory, the violation of previous secondary lows by both averages, to declare with certainty that the great bull market was over and that a primary bear market had officially begun. It was a call of incredible courage and historical accuracy, a testament to the power of his dispassionate, evidence-based approach. In conclusion, the legacy of William Peter Hamilton is that he was the great systematizer, the man who took the philosophical observations of Charles Dow and forged them into a sharp, durable, and testable tool for market analysis. He proved the theory's utility not through academic backtests, but through a lifetime of accurate public forecasts made in the most influential financial publication in the world. He provided a generation of investors with a logical framework for understanding the market's behavior, for identifying its primary trend, and for navigating its most dangerous and confusing moments. He was the man who took Dow's brilliant but unfinished map of the market and wrote the first practical navigator's guide. His work remains the intellectual foundation of technical analysis, a timeless reminder that even in a world of apparent chaos, there is a deep underlying structure for those with the discipline to see it. For any serious student of the markets, the foundational text on the psychology of speculation remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. The main character, Larry Livingston, is the prototype of Jesse Livermore. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below.